Hi everybody, Nicole Dominguez here. Today we're going to talk about a private placement offering, otherwise known as a PPO, and terms associated with a PPO that are important to every entrepreneur, such as a due diligence checklist, a term sheet, and regulations. So first let's talk about where a PPO is actually located. It's in a private placement memorandum, otherwise known as a PPM. A PPM is a document used to seek capital. It's important because it outlines the terms, what's expected of the investor, and the disclosures. Most importantly, it outlines all the risks so investors can be aware of what exactly will happen if the business deal goes sour. An entrepreneur can create a PPM, however, it needs to be looked at by an attorney because if not, even though you may think that you've crossed your T's and dotted your I's, any potential downfall can kill the business. So it's important to at least have an attorney on retainer. So let's review what a PPM is and why it's important. Next, let's talk about the PPO itself. A PPO is basically securities that are offered to investors. It's different from an IPO because it's not a public sale. Therefore, it doesn't have to be registered with the SEC. Some advantages of this includes being able to skip the underwriting, which saves time and expenses. You're able to handpick the investors that you want, which in the end might help you to look at the company and get advice from these investors and be able to make better decisions. And then finally, an advantage is keeping the company private. However, there are disadvantages with the PPO, such as greater risk associated with the PPO. Also, because there's greater risk, the market value of the securities could be a greater discount, which in the end doesn't look good to the entrepreneur. Next, let's talk about due diligence and a checklist we can look at to make sure that there's no stone unturned, either from the entrepreneur standpoint or investor standpoint. It's important for each of these people to look at what the due diligence checklist is, either from an entrepreneur standpoint to make sure that you're once again reviewing the PPM and giving the investor every reason to invest with your company and making sure they understand all the risks. And then on the investment side, you're able to look at that checklist and make sure that the entrepreneur has presented everything to you. So there's three parts of the checklist: the fund usage, the business plan itself, and the legal review. Some of these topics can range from how long do you plan to use the revenue? What are the timelines? Is there any litigation that could be involved with your business? Or what kind of burn rate do you have for cash? All of these things are important, and there's a very comprehensive checklist to go with that. Now let's talk about a very important part of the PPM, known as the term sheet. A term sheet outlines the specifics of the business investment. It's usually presented by the investor and shapes the understanding of both parties. There are many terms that can be included, but there's a couple that I wanted to point out because it's important in negotiations. The first has to do with preferred stock, which can include the liquidation factors and the dividends. The next is the reverse vesting, and finally, we want to look at the drag-along rates. First, with the preferred stock, investors will usually include this even though the founders of the company will have common stock. They do this to take control of the company. So, in event anything happens to the company, they're able to get their money first. Liquidation rates are exactly what you think they would be. In case of liquidation, once again, they get their money first. The dividends, however, are able to get a percent return per year on the company. The reverse vesting can make a lot of entrepreneurs angry because it allows a timeline that the entrepreneur would actually be able to get their common stock in the company, which you would think that an entrepreneur would be able to get their common stock right away. And then finally, the drag-along rates. This gives the minority shareholders the ability to liquidate the company. So in event of a down year when a company might be liquidated, shareholders would then not exercise this, and then the founders once again would not get any money. Again, overall, this gives power to the investors. Finally, let's talk about one of the biggest perks of a PPO, which is Regulation D. Regulation D is the most common law for a PPO, and it was created in 1933 by the Securities Act. There are 6 basic rules when dealing with Regulation D. 501, 502, and 503 deal with the conditions, the notifications, and the definitions of Regulation D. 504, 505, and 506 deal with the capital raising of Regulation D. Rule 504 states that there may be 1 million or less capital raised over a 12-month period with unlimited investors and no disclosures. However, states may supersede and have disclosures. Rule 505 states that there can be 5 million or less capital raised, and this can be in a period of 12 months or less and is restricted to 35 purchasers and as many accredited investors as you like. Rule 506 is offerings with an unlimited amount of capital raised. This is important to note because it also says that states do not supersede the disclosures, and there is certain disclosures necessary. However, states cannot provide any more terms. It's also 35 investors and an unlimited number of accredited investors. These are all important to decide which form of capital raising you would want. So, to summarize, today we've looked at a PPO and all the important terms that are associated with it, such as a PPM, a due diligence checklist, a term sheet, and regulations. As an entrepreneur, it's important to look at all of these different topics to fully understand how to get investors to actually look at your company. I hope you've enjoyed this presentation. Thank you for your time.